Well, good morning, everyone. It's very great to see so many people out on first thing in the morning. Obviously, this panel is really talking about why privacy will define the next wave of capital and blockchain. I'm Joy McKnight, a freelance and financial journalist and former editor of The Banker, which is part of the Financial Times Group. And I'll introduce my distinguished panelists. Today, we're going to explore why capital is increasingly flowing towards privacy-preserving infrastructure. So to my left, I have Dan Singelman, Chief Investment Officer at the Huskisson Family Office and Treasury Investment Manager at Input Output, a blockchain infrastructure research engineering company. Next to him is James Newman, Head of Relationship Management, Managing Partner and Fund Manager at Republic, a global investment platform for community finance. And then last but not least, Tommy Doyle, Head of Relationship Management at Zappo Bank, a crypto-friendly private bank headquartered in Gibraltar. Blockchain was designed to be radically transparent and to enable trustless verification. However, this transparency also renders it impractical for many real-world applications, as no business or bank will put sensitive financial data on a public blockchain. As stablecoins process over $27 trillion in annual volume and institutions prepare to move treasury operations on-chain, privacy is no longer a luxury feature. Instead, it's now table stakes for any system that wants to handle real money at scale. And just last week, Seismic, a Web3 security startup, raised $10 million to enhance privacy solutions for Layer 1 blockchains. So I think this can be seen as part of a shift towards privacy-focused blockchain solutions. So I'm going to pose my first question to Dan, which is, let's sort of take a step back and think about the barriers. So what are the barriers that prevent large institutional capital, such as from a large pension fund, to come into the blockchain space?
Yeah, thank you. There's a lot of barriers that exist. One of those right now, I'm going to say, is these lights. I've been on these panels quite a few times, and these are some bright lights today. I cannot see anybody out there, so I'll break the ice that way. So I used to manage billions and billions of dollars for institutional clients. We had central banks, private wealth funds, sovereign wealth funds, retail, and we would, onboarding them was the first step, but they would also kind of go through an RFP type process. And a lot of the times they were trying to find out is how do they maintain confidentiality and privacy. And this is just in your regular old TradFi type world where you're replying to RFP type questions and the money kind of comes in. What we need to do, if we really want to open up blockchain, is we have to allow privacy and confidentiality for these types of clients. The principal reason why they would come over to the blockchain world is because there's different types of return streams that they can get in blockchain space that they cannot get in your traditional finance space. Anybody can go get T-bills or corporate bonds or Apple stock or Amazon stock. That's fine, and we've solved that. But if we want to bring this on-chain and bring that large capital base from these institutional investors, we need to give them the same kind of suite of protection and privacy that they experience in their traditional portfolio. So we need to bring things like Midnight with privacy, confidentiality, the fourth generation of blockchain technology that allows them to hold these kind of trade secrets. You want to send $100 on chain? Sure, no one really cares. You want to send 100 billion on chain? You need privacy, you need confidentiality. You don't want to give up your trade secrets for these types of things. I managed multi-billion-dollar portfolio for United Nations, and one day they called us at 9 a.m., it was a Friday, and they said, we're going to send you $2 billion more. The only people that knew about this transaction was me, my back office, and the custodian to confirm that transaction. A $2 billion wire hit the SWIFT network, then hit the custodial account, and then I started acting. We need to do the same type of things in blockchain space. Because what they actually did that day is they sent $6 billion out. because there was 3 clients that were managing the same type of portfolio for them. And I didn't know this until later. But if you were to do this on-chain now, publicly disclosed, and I know, oh, that's the UN's account, and they send $6 billion out publicly, and I see it goes to 3 different parties or 2 different parties, you're giving up informational advantage, and markets move. This is what we need to protect against. So blockchain technology, bringing them into the space, bringing those institutional clients in, we need to give them the same kind of protections and comfort that they experience in their traditional portfolios as they would in the blockchain space.
I think it's a great point. And if you look at Twitter, for instance, last night with BlackRock and all the Twitter comments on the Coinbase move in both in Bitcoin and Ethereum, one of the hurdles, outside of regulation is clearly privacy, because, the best thing of blockchain being it's so transparent and it's trustless, etc. But you can't move that amount of notional without then all of these ripples and go and judge for yourself. Are they selling? Are they rebalancing their existing portfolio? And then you just get speculation, which is unhelpful for everyone. I think one further point outside of just the notionals around the trading aspect, which is obviously a huge, huge point. Just also think of the trust in providers, right? And I think this is where Midnight have excelled in terms of and sort of distanced themselves from other peers. I worked at Citigroup at one stage, not too far away from here, actually, in Canary Wharf. And it may be outdated, it was a couple of years ago, but Citi was the most hacked institution in the world. And that was because they do the payroll for the US Army and the US government. Right? Now, if you look at blockchain, and that in Citi's specific case, I worked in the markets division, but they're paying US representatives, I think in 70 plus countries on a monthly basis. Perfect for stablecoin, perfect for blockchain. Right? Remove the corresponding banks even below the Citi network, make it easier for US government officials and army officials to be paid globally. There's an easy case there. The reality is, who are they going to trust with that sensitive information that could effectively bring down a sovereign state such as the US? And so that's really, the pipeline of where we go from here is really interesting. I think we'll get there, but it's not an overnight.
Just to add to that quickly, it's not just about trust and privacy, it's about understanding and education. A lot of institutions really need to understand how the institutional grade infrastructure that is being built will actually integrate into their existing systems. And on top of that, if you think about privacy, it needs to be thought of privacy as a feature. And I think privacy in the digital asset world has often been seen as secrecy, and secrecy is seen as something nefarious. And with a lot of the privacy-focused tokens that have been out there from the last cycle, which have obviously been dragged into the limelight recently, I think it's quite interesting that we need to move away from secrecy and towards privacy and what benefits this can bring. And that will get the institutions comfortable with actually using a number of the primitives that we want them to use.
Yeah, it's the disclosure side of things. Again, if you and I are transacting on-chain, maybe I have an option position, the strike is at something, and Tommy sees that I'm posting margin. He doesn't see the amount. We could wrap it in some type of a ZK tech, right? And we don't know the size or even the directionality, but every day at 4 o'clock, as soon as the market closed, the margin clerk comes by and he says, oh, you got to post more margin against this position because it went against you. Now you see that this is taking place. Sometimes a little packet goes up and sometimes it comes down. Back to me, it's still disclosing some information, then you start trading against me, and then I get into a defensive type position. So it's more than just how do we bring big sums of money on, right? That's we need to protect that, right? But it's also about protecting the small little market structure bits. And having, companies have trade secrets for a reason, right? Coca-Cola's not going to tell Pepsi-Cola, hey, we're sending lots of money back from Thailand to Atlanta, Georgia. They're trying to, you have to maintain that level of corporate privacy because there's, profit margins to be protected.
And on that privacy aspect, I think that obviously everyone in this room is pretty educated towards ZKP, this type of encryption technologies. When speaking to friends, family, parents, I think it's really interesting to use analogies. And I always go back to the one regarding going to a nightclub or a pub where I get out my driving license and give it to them. In that moment, I'm disclosing a significant amount of private information. They know my name, they know my date of birth. They don't need to know my date of birth. They need to know the age verification part of it, that's it. And they know your address. That is a security concern on a personal level. They know where I am and where I am not. And that is the same thing that translates towards the traditional finance world, the trading world, in these things. And these things will, if they are visible, will be exploited.
James, there's no way you go to a club.
All right, well, you've brought up a lot of really interesting points, and I think we'll get to come back on quite a few of them, actually. But Tommy, I was going to pose the next question to you, which is really around, okay, we've talked about big institutional capital, et cetera, but then how important is privacy for your clients, like the high net worth, the family offices, et cetera? And, is this a major concern?
It's a huge component, actually, and we can kind of run through. If you think of Sample Bank as being the original Bitcoin bank, we've evolved into a bank for retail. We're in 90-plus countries, but also a lot of that retail have made substantial gains in Bitcoin. They've been with us since 2013, so they have family offices or special purpose vehicles. Yeah, I mean, I will tell you an almost amusing anecdote of we onboarded a very large family office, probably a top 20 family office globally. I won't say the jurisdiction. And they wanted to go and see our bunker. We run an MPC custodial model with a nuclear bunker hidden in the Genevan Swiss Alps. And the problem was, almost looking at it from their lens, they wanted to send the son of the family of the UBO and then some security. And by definition of seeing a secret bunker, there's a protocol to follow. So you have to put your phone in a bag that shows you can't, reassess the geolocation where you've been. This was a problem for said family because they had kidnapping risk on the individual, and it came down to, well, look, I'd love you to on board, I'd love to open an account, but you can't go and see a secret bunker and know where it is. It just defeats the purpose. And so we had to be quite blunt. So they went, and so secrecy definitely. I think if you break down the privacy, to Dan and James's point, almost see it as two functions: the effective capital markets section, and then the trust section. And this latter one was, okay, the security and the trust. And we are still new entities, right? And so we've onboarded a large Singaporean family office, and they said, hey, DBS are active in crypto, why should I bank with you? And I said, look, to be fair, you should come back in 10, 12 years after DBS had been live and ask me, why should you bank with DBS, right, for crypto? Because crypto is a different asset class with different risks. Conversely, I wouldn't try and sell them traditional finance and compete with DBS. But on the effective capital markets, if we just pigeonhole that, again, to James's point of secrecy, privacy almost being seen as secrecy and against the aim of the blockchain. The blockchain is, by definition, trying to engage, empower people of all backgrounds, and blockchain doesn't care where you come from and where you're based, right? But to do that effectively, it needs an effective capital market, and there's certain rules that we've relied on, and disclosure rules in equity and credit capital markets that have actually allowed those to function. And so, I worked in equity capital markets. You could buy, may have changed a little bit now, but like just under 10% of a Spanish equity without disclosing to anybody, right? And so is that secretive? Is it privative? This is illicit equity. Everyone in the world can access the IBEX. But the reality is, to allow people to build up derivative positions and structured trades, they need a framework. And the UK, it's slightly patched. The UK is slightly lower. Germany, it's just under 7%. And so those rules are in place to allow, to Dan's point, large notions of capital entering a market within a framework where they're not going to be seen. Because I think that is, from a capital lens, a real concern if you're trying to move, $400, $500 million worth of a crypto asset.
Well, it's interesting as well when you talk about a bank, because when a blockchain is great, anywhere someone has an eraser and can kind of change the rules to their favor. Charles was talking about this yesterday. That's where blockchain technology is really good, right? Because it's decentralized and no one will have that kind of authoritative power. When you bring this on-chain, and then you bring privacy confidentiality, you can have new companies that start to exist, like a bank, a full on-chain private bank, like with a current account or a checking account. This is what you can start to have. And this is what's really exciting about this technology, is you're going to have all these new types of companies that are going to be created because of this privacy component that you're adding. In Midnight, I know we have a company in our testnet right now that wants to do private payroll. This gentleman has 20 employees, and right now he's paying them in USDC, and they get to see everything on-chain. So he has 20 people that he pays from a public wallet. And let's say I am employee number 7, and I go and I look at my wallet, and I say, oh, okay, let me just see where I got that from. And I look, and there's 19 other payments that went out. And I put those into a distribution, and I see, because I'm employee number 7, that I'm on the left side of that distribution. I don't know exactly who my peers are within that distribution, but I know I'm underpaid relative to my peers. And I go and I complain. So what we need and what this company wants is a regulatory compliant way to do regular business. Like we had these great, amazing, functions and features from like the 60s, the 70s, even to today, and now we're trying to shoehorn blockchain into this, but we kind of forgot about privacy and confidentiality, that real businesses, real society functions off of people having the ability to choose, do I want this private or public? And I think that's where we're trying to get to with the next generation of this tech.
Excellent. All right, well, let's talk about where the investments are flowing now. And so, James, I was going to ask you sort of what specific technologies are attracting the most investment, and why would you say that? Why do you think they are?
There's really a few verticals that are attracting investment, and areas in particular that we're focusing on. Firstly, ZK proofs, that vertical of technology, whether it be integrations, new L2s, roll-ups. I think that's paramount for this space, and it's clearly getting a lot of traction. It's been around a while, but we're really seeing a kind of critical mass formatting around this. I think the second side of things is around payments, payment stablecoins, and doing so in a private way. To Dan's point, in the payroll example, it's absolutely paramount. It's necessary, it's needed, and there is a demand for it. And if the likes of Bridge and others that have been acquired recently are really going to proliferate, there is the necessity for this equivalency of what is private in traditional banking rails. Lastly, it kind of alludes to a number of points made, but it's about identity. And it's if we're going to have a certain system or a whole upgrade of the institutional infrastructure being moved on chain, then you need to have that ability to identify yourself, be able to disclose certain parts of information in a compliant KYC, AML, and also regulatory compliant manner. On the traditional finance side, it's absolutely paramount for trading. On the day-to-day, you want to be able to disclose information that is relevant towards the process, the transaction that is taking place, but not too much information. And I think these are huge white spaces in which there's a significantly large TAM to invest in, and these are the areas that I quite like.
Dan, did you want to come in on this?
Yeah, so this is what's coming, right? Midnight or other blockchains. Well, I'm going to use Midnight. Midnight is building the roads, the foundation, the structure to which the cars will be driving on, right? And so what we need is builders. There's a hackathon that's going on now. I need the builders to build the cars, and the people will go inside the cars. On most blockchains, they're doing the same type of a principle, and those cars have clear and transparent windows, and you can see everything that's going on inside the car. But with Midnight, it'll have blackout windows or different types of gradation in the tint. With that selective disclosure, you can see some things that are going on inside the car, inside the company, but not others. This is where we need to get to, is allow different companies to be built, different features to be built that allows for different choices of privacy, public or privacy.
Excellent. Tommy?
It's a sensitive subject. I've had 3 cars stolen in London, actually, so I can't on Uber. But no, I completely agree. Look, from our lens, payments is huge, right? We were the first bank to that's Bitcoin focused to adopt both Visa and MasterCard globally. I think if you look at the layer below the banks, the corresponding banks is ripe for disruption. We've seen Coinbase look at BVNK and a few other deals. I think that'll continue to be a hot sector. For us, going back to Dan's point, I think, and James too, that institutional adoption, we'll see that typically in a family office and ultra high net worth, and to some degree sovereigns as well that are coming through. It's that reliance on the current ecosystem and framework is too visible, it's too transparent for those sovereign states. I mean, we had a sovereign that have subscribed to our BTC fund. Delighted, but I can't tell anyone about it. So it's kind of it is what it is. But I think that was a separate case of it's a regulated fund, it's off chain in terms of the subscription, so it met their hurdle. But if that was all on chain, they just wouldn't technically be feasible for them to invest right now. So hence the need for someone like Midnight to help.
Yeah.
Excellent. But as there's increased investment in privacy, do you think this is going to attract sort of a heavier regulatory response? James, I was going to ask you first.
Yeah, of course. I think it will. I think that's generally a good thing. I'll make one point before I pass on to others, but it's really about some kind of level of like regulatory standardization around privacy. I think regulation has been pretty heavy on that vertical, and I think it's because there's this perception, whether it's true or not, that it facilitates nefarious transactions, behaviors. I don't want to go into a debate of what cash or traditional banking rails has already transacted. Is to be debated, but not here. The point is, it has that perception from numbers in the market. So regulatory clarity around what type of processes, infrastructure, what is secrecy, what is privacy, is absolutely paramount. And with clarity, things become very investable. And that's really where I'm focusing. Clarity means that I can invest in things and not take that, or not have that real left tail risk towards something being non-compliant, which is problematic not just from a kind of investable standpoint, as in losing money, but also from a fund structure. It's problematic to have these in your fund.
I think identity is a tricky one, because when you start aligning that with AI, and then how do I even regulate that on a global basis is a challenge. I think it needs to be addressed, right, in terms of there's a balance between what data am I comfortable putting online versus, and how's that stored, and who polices the policeman, really, which is the biggest threat there. And especially now some of these firms have just become so big. Correspondingly, I would say, if you look back in financial press, about 2-3 years ago, every time Bitcoin was mentioned, and this is me being Bitcoin biased, the carbon footprint was in the same sentence. And it's like, Bitcoin miners, here's their carbon footprint. Thanks to NVIDIA and AI, we no longer hear about carbon footprint. It's about how many gigawatts each miner can allow for AI technology. So the world moves on quite quickly, and because that's a focus, I think that'll be sort of elaborated and probably looked at in conjunction with AI, because it's a real issue for people, especially the next generation coming through. I will say, finally, on the Uber on the way here, the Uber driver asked him if he was in crypto just to kill some time, and he had a 15-year-old son, so I don't know if he's accessing crypto legally or illegally or through his father, but he said his top pick was Midnight, which I thought was quite ironic, given that I ended up here.
Fantastic. Did you want to
We need regulators, because we need the rules. Just tell us the rules, and we'll know how to play the game. We have GDPR, we have the travel rule, there's other rules and regulations that are out there, but we need this. And the unique thing about the tech and the blockchain space is it's programmable, because the regulators in Costa Rica might have different rules and regulations than the ones in Japan. And at the foundational level, like as I was explaining, that tech needs to be adaptable and moldable to all those different regimes, all those different countries. It's not up for us, blockchain space, to say these are the rules that we want to play by. Argentina has different rules than Canada versus Kenya, and that's what we have to be adaptable to and moldable to, because there's just different societal differences all around the world, and the code can be adaptive to that and still then be moldable and applied to benefit those companies and regulators and consumers.
But do you think there will be a harmonization of regulation around this? It's very hard if every regulator is taking a different approach. It's very difficult to...
There's foundational sides, right? We need to know who the person might be, different types of elements, where do they come from, wealth, age, race, sex, these types of things. Just like a casino might need to have that information, or just like when James was explaining, with his, ID, you don't need to know everything. But that's the interesting thing is, yes, there are certain core fundamental things that like all regulators around the world would need to see, and it's, up to us as citizens, private citizens, to disclose how much of that information we want to give up and participate in that network or that application.
Excellent. All right, we only have a few minutes left, which is a bit of a shame because it's been such an interesting discussion. But maybe my last question, and it's to all the panelists, but I'll start with Dan, which is what more needs to be done to increase that institutional adoption and get institutions prepared to move treasury operations on-chain? And maybe my other question, we can do two at once, which is that, in a room full of developers, what should be builders, developers, what would you sort of, call out to them to take action around, or what they should be doing?
I need you to build me this application. Because Fahmi and I have been on the road talking about this for many, many months and quarters. Build this and you're going to make a lot of money. Here it is. Tokenization is not about tokenized T-bills. That is like a complete waste of talent, like, and tokenized stock. Who cares? We already have that sorted out. You want to put that in your Robinhood account or your trading account? It's fine, it's easy. You want to put it on blockchain? Ring-a-ding-ding. What tokenization is really going to do is it's going to open up corporate balance sheets. Right now, if I wanted to get exposure to Coca-Cola, there's one way to do it, and that's with the stock ticker KO. And when I go and I buy that and I put it into my account, I get the return, the dividend, the price return, whatever else from these guys. But I don't want to have exposure to all of the Coca-Cola products. I only want exposure to the best product, Diet Coke. I think you guys call it Coca-Cola Light over here. So what Coca-Cola is going to be able to do with blockchain technology, privacy, confidentiality, is they're going to be able to open up that balance sheet, and they're going to be able to tokenize a certain vertical. In the mortgage world, we call this a mortgage pass-through. And what they're going to be able to do, maybe it's a 3-year type term, is they're going to tokenize the return stream of Diet Coke. I will get exposure to all of the revenue and all of the costs, and at the bottom line will be the net income or positive free cash flow. That should trade at a higher multiple relative to Coca-Cola broadly. Nobody likes Sprite. We all want Diet Coke or Coca-Cola, or what do you guys call it, Coca-Cola Max or something, or sugar-free, whatever it's called. I don't know what you call it over here. But that's what's going to happen. And it's not just with Coca-Cola. You're going to see other companies. They're going to start to monetize their balance sheets. Before, they would split off an entire vertical of their company and sell it off. Now, they can just take a slice of it and expose this. And this is what's going to bring in those institutional investors, because that is a different type of return stream than they can get just getting Coca-Cola. So now I'm going to start building and constructing a portfolio of Diet Coke, and I want the Ford Mustang exposure, and I want the Pringles exposure. That's what we're going to start to see with tokenization. That's what this technology is going to do. So if you're a builder out there, please, you're going to be a billionaire within a year if you can build that tech.
James, can you add to that?
Not sure how to follow that.
Yeah.
Just told you the secret sauce. I would say from the builder question, I think privacy can be incorporated at different levels or different layers into things that is being developed, and I would urge you to incorporate it at a kind of more foundational base layer level. I think it's paramount. I think it's easier than patching things on later down the line. Regarding what institutions need, I think we touched on some of it, but regulatory clarity. There's a significant education piece. I think the understanding that the infrastructure stack is going to change, but that takes time, and that not everything is going to move on-chain. Not everything is going to stay off-chain. There will be hybrids as things develop towards a more on-chain model. And with that, I think the understanding of the things and pieces that are needed, privacy clearly being one of them.
Excellent. Tommy,
Yeah,
we have 30 seconds.
Perfect. That's more than enough. I guess from my lens, we get pitched products quite a lot at the bank. I would just take a solutions-led approach, right? And so what problem am I trying to provide a solution for? And in reality, that's only two things. You're either cutting costs or increasing distribution, right? And so you're either having more customers or lower costs, right? That's what makes something more profitable by definition. I think a lot of people get lost on a problem that's not yet there or maybe there, but there's plenty of problems to Dan and James's point that we can provide solutions to right here, right now, where you can do very well.
Excellent. All right. Well, fantastic. I think we're right on time. Thank you so much to the panelists, Dan, James, and Tommy. Thank you very much. Thank you.